Hi everyone. Our topic today is about cash flow analysis. Why do you think sufficient cash flow is important for a business? And what are the purposes and advantages of cash flow statement? Whatever the size and age of your company, the need to manage cash is vital to its continuation. Here, I share some quotes on cash flow that you may have heard of. To emphasize and appreciate the importance of cash flow to a business even further, let me tell you a brief story of a restaurant business. Let's call this person Alex. He used to run a successful restaurant. Indeed, he had been in business for over 10 years now. Every night, he had hundreds of customers, and everyone knew him in town. He was named Restaurateur of the Year. The future seemed so bright. In fact, he believed that having popular customers made his business grow faster, or at least made it more popular. Therefore, half of his clientele was comprised of popular people in town. Many of them went to his restaurant, and also bringing other people along. Alex allowed his prestigious customers to open credit accounts, called VIP accounts. Therefore, they could come at any time and pay whenever they were able to. Initially, this seemed to work. More regular customers came in, and his profits skyrocketed. Although business had never been so good, he was short of cash. Furthermore, salaries for half of the staff were not paid. The staff loved Alex, and they were willing to stay few weeks more without getting paid. But they expected him to pay within the month. Taken aback, he went to the bank and asked for a loan. Once there, the director of the bank, a longtime friend of him, wanted to help but couldn't. Even though the business looked successful from the outside, it was actually bleeding from the inside. Cash was short. Nonetheless, the restaurant produced $50,000 in profits. There was a $20,000 hole due to unpaid balances by customers. In fact, the account receivables showed over $200,000 due. 75% of it were over 2 years old balances. The bank director told Alex, if he wanted to borrow money, he had to improve the cash situation. Therefore, he turned to his managers, and asked them to use any methods to collect the money, lumped as accounts receivable. The accounts receivable skyrocketed in the last 2 years. Mainly due to the VIP accounts. Lately though, the restaurant managers were trying to collect the balances from the customers. The VIP accounts holders felt offended. They decided to avoid Alex's restaurant, and not to pay their balances. Not only Alex lost the chance to collect the money lumped in the accounts receivable, but half of the clientele was gone too. Further, his employees decided to leave. Alex did not see any other solution than closing the business and declaring bankruptcy. The hole went from $20,000 to over $200,000. What seemed to be a profitable venture, and what seemed to be a small cash issue, turned out to be bankrupt. This was mainly due to the poor cash management by Alex as the owner of the restaurant. Alright. From this short story, you can get some insights on why cash flow management should be a company's top priority. Because if cash flow is planned properly, the effects will not be as dramatic as it would otherwise, like what had finally happened to Alex's restaurant business. Before we move further to the explanation on cash flow and cash flow statement, let us first define. What is cash? Cash is also known as money, in physical form. Cash, in a corporate setting, usually includes bank accounts and marketable securities, such as government bonds, and bankers' acceptances. Although cash typically refers to money in hand, the term can also be used to indicate money in banking accounts, checks, or any other form of currency that is easily accessible and can be quickly turned into physical cash. Cash flow, on the other hand, are the inflows and outflows of cash and cash equivalents from operating and other activities over an accounting period. This information is used to form a cash flow statement, a crucial document for analysts and potential investors. It helps to assess the liquidity or the ability of a company to generate cash and cash equivalents, and examine the needs of a company to utilize cash. The statement of cash flows provides a summary of the company's cash flow and other events that cause changes in its cash position. This statement essentially brings together items from both balance sheet and the income statement to show how the company obtained its cash and how it used this valuable liquid resource. However, with the accounting conventions that is the accrual concept, a company may bear some distinction between profit and operating cash flow, reported from the two financial statements. That is, whereas profits are simply the difference between revenues and the accounting costs that have been charged against them, cash flow is the amount of money a company actually takes in as a result of doing business. The statement of cash flows reports cash receipts and cash payments by operating, financing, and investing activities, the primary business activities of a company. Operating activities are the earning-related activities of a company. Beyond revenue and expense activities represented in an income statement, they include the net inflows and outflows of cash, resulting from related operating activities, like extending credit to customers, investing in inventories, and obtaining credit from suppliers. Operating activities relate to income statement items, and to balance sheet items, relating to operations, that usually working capital accounts, like receivables, inventories, prepayments, payables, and accrued expenses. Investing activities are means of acquiring and disposing of non-cash assets. These activities involve assets expected to generate income for a company, such as purchases and sales of property, plant, and equipment, and investment in securities. They also include lending funds and collecting the principal on these loans. Financing activities are means of contributing, withdrawing, and servicing funds to support business activities. They include borrowing and repaying funds with bonds and other loans. They also include contributions and withdrawals by owners, and their return, which is dividends, on investment. You can also refer to the SC module, on page 61 to 63, for examples, on specific activities or transactions, arising from operating, investing, and financing activities of a company. In order for you to fully understand the cash flow statement, you have to change your perspective. So far, we've looked at the income statement and the balance sheet through the accrual basis lenses. It is time now to shift your perspective to the cash basis. What does it mean? Well, take an example of one item under current asset, which is accounts receivable. Let's say, account receivable went from $100,000 in year 1 to $200,000 in year 2. From the accrual basis or standpoint, it means an increase in asset. But what if we change our perspective and we look at it from the cash standpoint? Well, from the cash standpoint, increase in assets means a cash outflow. Why? The reason is simple. Let's say the company starts the first year with accounts receivable of $100,000. In the following year, the company allows the customer to pay in 60 days, instead of 30 days, which that means the customer gets a free month, while the company have to wait an extra 30 days to collect that cash. With the additional 1 month delay, the company's cash flow would have only 11 monthly payments, instead of 12. That extra month would, at the end of the year, reduce the company's cash flow by $100,000. Hence, the purpose of the cash flow statement is to look at cash inflows and outflows for a certain time frame, with no regard to profits generated. So, keep in mind that an asset increase means a cash outflow, while an asset decrease means a cash inflow. Meanwhile, a liability increase means a cash inflow, and a liability decrease is a cash outflow. The cash flow matrix shown in the slide will help you remember this basic assumption. There are two acceptable methods for reporting cash flows from operation, the indirect and direct methods. While both methods yield identical bottom line results, their format differs. The direct method adjusts each income item for its related accruals and, arguably, provides a better format to assess the amount of operating cash inflows. Companies are encouraged to report their cash flows from operating activities using this method. The advantage is that it provides a better format, which is to assess the amount of operating cash inflows, and hence, the information provided may be useful in estimating future cash flows. With the indirect method, net income is adjusted for non-cash income, expense, items and accruals to yield cash flows from operations. An advantage of this method is the disclosure of a reconciliation of differences between net income and operating cash flows. This can aid some users that predict cash flows by first predicting income and then adjusting income for leads and lags between income and cash flows, that is, using the non-cash accruals. The indirect method is most commonly employed in practice, and we use it initially to illustrate preparation of the statement of cash flows. Please take note that the format for computing net cash provided by investing and financing activities is the same for both methods. Only the preparation of net cash flows from operations differs. Referring to my earlier explanation, reported earnings or income, as opposed to cash flow, is measured on an accrual basis, while cash flow is reported on a cash basis, and hence not affected by accounting treatment. Therefore, income reported in the income statement is not the same as cash generated during the accounting period. A cash flow statement is valuable because it helps users to determine how much cash a company actually spent and received in a year. This is important because a company that shows positive earnings on its income statement may spend more cash than it takes in, and that could lead to financial distress. In a nutshell, it allows for a different perspective of the company's performance compared to the income statement. Having said this, the cash flow statement is not an isolated statement by itself, but it has its link with the income statement. And the balance sheet is shown in the following example. Now, let us take a look at the interlink the cash flow statement has with the two financial statements, income statement and balance sheet. The very first step, and important in the construction of cash flow statement, is to find the non-cash items from the income statement that did not contribute to any actual cash inflow or outflow, to yield cash profits that are then further adjusted for cash generated and used by balance sheet transactions to yield cash flows from operations, as well as investing and financing activities. The starting point for the statement of cash flows is net income, which we first identify for non-cash items such as depreciation and amortization expense, impairment, and profit or loss on sale of non-current assets. Further items are required for the cash movements in the working capital items. All these items need to be added back to the net income figure in the cash flow statement. Now, if you refer to the example from Universal Office Furnishing Incorporated, you will notice that the Universal's 2019 cash flow from operating activities was $195.6 million, down slightly from the year before. This amount was more than enough to cover the company's investing activities at $97.1 million and its financing activities at $82.7 million. Thus, Universal's actual cash position increased by some $15.8 million. The operating activities section begins with net earnings of $139.7 million for 2019, which is then adjusted for non-cash depreciation and amortization expense of $77.1 million. Also note that changes in current assets and liabilities are reflected as cash inflows or outflows, using the cash flow matrix presented earlier. From the Universal's balance sheet, we can identify the changes in working capital items from year 2018 and 2019. The increase in receivables and other current assets indicates cash outflows of $34.8 million and $28.4 million, respectively, by the company. Inventories that decrease by $3.8 million, on the other hand, is considered as cash inflow to the company. Looking at the current liabilities side, you can notice that accounts payable and short-term debt increased by $31.8 million and $95 million, respectively. Vice versa, the decrease of other current liabilities by $4.1 million is the cash outflow for the Universal Office Company. From the explanations and examples given, we now know that both the income statement and the statement of cash flows are designed to meet different needs of users. The income statement uses accrual accounting basis in recognizing revenues earned and expenses incurred. Cash flows from operations, on the other hand, report revenues received in cash and expenses paid. It is not an issue of which statement is superior to another, only a matter of our immediate analysis needs. Our use of these statements requires that we bear in mind the statement's objectives and limitations. Basically, the cash flow statement is useful to provide information to external users of the financial reports. By enabling them to gauge the ability of a company to generate cash and meet its debt obligations for their creditors, as well as being able to pay out dividends for their shareholders. The statement also provides information regarding the company's needs for external financing, and gauge the capacity of a company for funding changes, depending on the scope and nature of its activities. As for the internal users, the cash flow statement is useful to help the management in planning and controlling the operations of the company. Based on what being explained earlier, we can say that the cash flow statement complements the income statement and the balance sheet by providing further information on liquidity, viability and financial flexibility of the company. From an analysis point of view, this statement helps users to assess the potential of the company to generate future cash flows and hence, determine its financial strength and weaknesses. In specific, the analysis of the statement of cash flows enables us to appraise the quality of management's decisions over time, and their impact on the company's results of operations and financial position. When our analysis covers a long time period, it can yield insights into management's success in responding to changing business conditions, and their ability to seize opportunities and overcome adversities. Inferences from the analysis of cash flows may include where management committed its resources, where it reduced investments, where additional cash was derived from, and where claims against the company were reduced. Inferences also pertain to the disposition of earnings, and the investment of discretionary cash flows. And finally, analysis of cash flow statement also enables us to infer the size, composition, pattern, and stability of the operating cash flows of the company. Well, I guess that's all for Chapter 7 on cash flow analysis. Please read your textbook and additional reading material from Securities Commission that I've shares with you, to further enhance your understanding on this topic. With that, thank you. And have a great day ahead.